The first topic we're going to be going over today is identifying behavioral biases that can result in poor investment decisions. For example, loss aversion, which is the first one we're going to be going over today. Loss aversion is a cognitive bias where the pain of losses is actually felt greater than the pleasure of equivalent gains. This would lead to holding on to investments longer than an investor should, selling growing investments too quickly, and lastly, dramatically decreasing risk of a portfolio, which can hurt the portfolio in the long term. And the second one we're going to be talking about today is going to be investing in employer stocks. So these are going to be an overconfidence in employer stock, which leads to less diversity within the portfolio. So for example, if the person works at Apple and they're giving a package for Apple stock if you stay at the company for a certain amount of time, then this would lead to an overconfidence in that single stock, and they won't invest in other more diverse stocks. And this leads to the portfolio becoming less diverse overall. This is also caused by insider knowledge and employee stock purchase plans, like I mentioned previously. The third one is home bias. This is where investors only invest in domestic markets or familiar companies. This results in, first, reduced portfolio diversification, secondly, increased portfolio risk due to lack of geographic diversification, and lastly, missing out on opportunities that they might not have seen because of a less diverse portfolio. The fourth is mental accounting. This is the tendency to treat money differently depending on its source or intended use. So, easily earned money could lead to less care in spending that money when coming to investing, or a different risk tolerance when it comes to spending certain money that may be earned easily or might have taken more effort to earn. The fifth one is confirmation bias. This is where an investor themselves is seeking information that confirms their own existing beliefs, and they also tend to downplay contradictory evidence. So this would lead to holding onto stocks for too long, and then that would lead to a loss, or they would lock onto poor investment strategies, which is not good for the long run. Another example of behavioral bias would be herding behavior. This is just following the crowd rather than making own decisions, which leads to buying at peaks and selling in panics, and often copying other successful investors. The last one we're going to be talking about today is anchoring bias, which is a fixation on a specific price or valuation. This can lead investors to hold on to investments for longer than they should, and decisions will be made based on reference points that they see. So just to sum all of this up for this topic, behavioral biases in stock investing tend to be mental shortcuts or emotional tendencies that can lead investors to make poor decisions. These tendencies can be from environmental factors. Lastly, just be aware of these biases, and being aware of your own biases can help investors make smarter and more rational choices. Some methods to avoid negative consequences would be, first, to develop a systematic investment approach, secondly, to diversify a portfolio, so not sticking to one single stock, and the third would be to balance investments. And lastly, would be to seek advice from multiple sources. This allows you to double check things you may hear from one source that may be incorrect, so it adds another layer of verification when it comes to investing. The second topic is financial technology can counterbalance negative behavioral factors when making investment decisions. So, first we're going to be exploring common financial technologies that are used for investing. This includes automated trading platforms. Going to be going over 4 today. The first one being Wealthfront. So, Wealthfront is a company that specializes in pre-built diversified portfolios, and they offer balanced tolerance and financial goals within that portfolio. And they also offer automated portfolio management. The second one is going to be Vanguard. This is an asset management firm, and it tends to be better for long-term investments compared to short-term investments. And QuantConnect, which is a quantitative research and algorithmic trading platform, which is more on the automated side. It offers a lot of personalization when it comes to automating your trades, but not much when it comes to creating a portfolio for you. And it also offers the option of starting with simulated money if you're just starting out. The last one is eToro, which is a social trading and investment platform that allows users to buy and sell assets, which includes cryptocurrencies, stocks, ETFs, and many commodities. They also offer smart portfolios focusing on long-term investment, and they also offer cryptocurrency trading, which is unique. The next one is going to be benefits of automation. So many of the services I mentioned before have automated services. Some benefits that comes with automation would be negating those behavioral biases in the ninth topic that I mentioned, and these will prevent emotions from affecting portfolio activity and trades. So having it be automated, the algorithm has the ability to adjust trades and the portfolio balance without any bias. This is also another benefit where you can ensure a portfolio is strictly aligned with the original risk tolerance and strategy. Many investors buy and sell financial assets through discount brokerage firms that provide inexpensive investment services and advice using financial technology. So in the 21st century, there has been the recent development in fintech, which is short for financial technology. This refers to the use of technology to enhance, automate, and streamline financial services and processes, this including portfolio management. So with this introduction, historically, investing was only a privilege for wealthy, the financially educated, and connected people. The introduction of fintech changes this because it lowers the barrier of entry, which is done through apps that provide financial education and low-cost investing. For beginners, they can learn through fractional shares and platforms like Robinhood with a mobile app, which makes it even more accessible. Next, we're going to be going over an example discount broker, which is Robinhood. So Robinhood has a $0 minimum starting balance, no minimum monthly investment, and no trading cost for stocks, ETFs, and options, but does include a small fee for trading cryptocurrency. There are many other discount brokers on the market that do similar things and do offer the similar benefits to Robinhood, but some do charge fees for normal stock investing and do require a minimum starting account balance. So Robinhood is beneficial in that, but it may also have some downsides. Lastly, we're going to be going over the advantages and disadvantages of robo-advising. So the pros are going to be it being more affordable, having 24/7 access, which a normal person would not be able to do. It's customizable and also easy to use. The cons of using robo-advising or similar services is going to be the lack of natural interaction between the advisor and the client, since it actually isn't a physical and real person. It's also going to be more dependent on the robo-advisor's activities, and the investor is going to be a lot more dependent on what the robo-advisor says. This can lead to more impulsive trading. Federal regulation of financial markets is designed to ensure that investors have access to accurate information about potential investments and are protected from fraud. The role of federal regulators is to ensure that the market is stable, transparent, and fair for all investors. An example of this would be preventing insider trading and market manipulation, which are both illegal. For example, the Securities and Exchange Commission, also known as the SEC, oversees securities markets, protects investors, and enforces federal securities laws. Insider trading, like I mentioned, is illegal and harmful to investment markets. So first, the definition of insider trading is where information within companies that is not publicly available enables investors to have an advantage compared to others outside of the organization. For example, let's say you work at Amazon and you find out that the Amazon stock is going to grow a lot in the next month. Then you would place an order to invest in Amazon before that growth. And since no one outside the company knows about this information, then this would be considered insider trading. So insider trading is illegal. The law was established within the Securities Exchange Act of 1934, where federal legislation prohibited insider trading. Insider trading can be harmful to investment markets as it prevents full market transparency, breaks market integrity, and gives certain investors an advantage over others. Having access to full and accurate information about potential investments is very important. So having transparent information and everyone having the equal amount of information is really important because it enables decision making for risk assessment, strategic allocation, and creates a level playing field when it comes to investing. It also facilitates comparisons between investments in the same sector, which allows for long-term planning. Investors often compare the performance of their investments against a benchmark, such as a diversified stock or bond index. So the purpose of these benchmarks, like the S&P 500 index, are primarily used to assess if an individual stock is outperforming, underperforming, or matching the broader market. So a stock could be having a trend where it's actually underperforming, which means it's not increasing in value as much as the market is. It also measures the effectiveness and success of an investment. So that's the two main uses of comparing portfolio performance to a benchmark. So I'm going to compare three really popular benchmarks right now. So the first of it being the S&P 500. The S&P 500 had record highs at end of Q3 of 2024, which is this year, and 5.89% returns in the quarter, and high returns of 22.1% year to date. The Dow Jones Industrial Average, which is the second benchmark we'll be comparing, had a 13.9 return year to date, which is lower than the S&P 500, and 8.72% during Q3. The last one we're going to be comparing is NASDAQ, which is having a year to date of 27% return, and it's driven by Nvidia, Microsoft, and Apple. So this had the highest year to date return of all three benchmarks due to being a lot of the biggest tech companies like Apple. So moving on from benchmarks, we're going to be talking about the advantages of an ETF. So first, an ETF, which is an exchange traded fund, is a type of investment fund that trades like a stock on an exchange throughout the day, but are more similar to mutual funds that trade like stocks. When investing in an ETF, you have a reduced risk because ETF contains many companies in a sector and it fluctuates less. So they also tend to be more transparent with a daily disclosure of holdings, which makes it easier to keep track of. Topic 14 is criteria for selecting financial professionals for investment advice, including licensing, certifications, education, experience, and cost. So you might be wondering, why seek assistance? Assistance is good for those who are just starting out with limited experience in markets and also need help with portfolio diversification. They can help clients stay disciplined and give advice during tough market situations that the investor may not have encountered beforehand. When finding an investor, it is also very important to take note of licensing, certifications, education, and experience of that advisor, as criteria for selecting a financial professional for investment management or advice is very important to consider. It is important to check for certifications and experience as it helps a customer determine a professional's credibility and expertise. Since a market has many fluctuations and patterns that need to be studied, there is a certain educational bracket that needs to be met. It also proves that they have the legal ability to give financial advice, to understand market complexities. Lastly, where and how to find qualified financial professionals. So one place would be the Financial Industry Regulatory Authority, or also known as the FINRA. They have a directory which lists out financial professionals and their certifications. The second place would be the SEC's Investment Advisor Public Disclosure website, where you can find and verify credentials of a certain advisor. Another good option that may be less credible would be word of mouth and online recommendations.